Hey, Ticker Shock fam, Dave here, ready to dissect the market's biggest movers. What if I told you that despite billions being poured into generative AI, a staggering 95% of companies are seeing zero measurable return? Yeah, you heard that right. Today, we're diving into how this Gen AI divide could rock a tech titan you know well, Oracle. So what's the buzz? A recent bombshell report, The State of AI in Business 2025 by MLQ.ai in collaboration with MIT Project Nanda has dropped a serious truth bomb. It reveals a massive Gen AI divide. Enterprises have sunk an estimated $30 to $40 billion into generative AI, yet 95% of them are failing to see any meaningful return. While tools like ChatGPT and Microsoft Copilot are booming for individual productivity, over 80% explored, nearly 40% deployed, the real struggle is with enterprise-grade solutions. These custom or vendor-sold systems are hitting major walls. 60% evaluated, only 20% make it to pilot, and a measly 5% ever see production. The core issue, a learning gap where these systems can't adapt or improve over time. Plus, there's a shadow AI economy with 90% of employees using personal AI, often bypassing official company channels. This report suggests that successful AI is often found in the back office, not the flashy front end. This is huge, especially for companies betting big on enterprise AI adoption. Now, let's talk Oracle, ticker ORCL. Founded back in '77, this Austin, Texas giant is a powerhouse in enterprise tech. Their main game is providing products and services for IT environments worldwide. Think cloud software like Oracle Fusion Cloud ERP for managing business operations or their human capital management suite. They also offer crucial infrastructure technologies like the Oracle Database and Java. In fiscal year 2025, Oracle raked in an impressive $57.4 billion in revenue, an 8.38% jump from the previous year, and their EPS hit $4.46. Looking ahead, analysts expect a massive 57% surge in EPS for 2026, reaching $7.02. Their cloud and license business is the clear revenue driver, pulling in over $49 billion. That's a whopping 85.77% of total revenue. Services contribute about 9% and hardware about 5%. Geographically, the Americas is their biggest market, bringing in over $32 billion. Oracle is clearly all in on cloud and AI. So how does this Gen AI divide report hit Oracle where it counts? Oracle has been positioning itself as a go-to place for AI workloads, signing massive contracts with the likes of OpenAI, xAI, Meta, and NVIDIA. They're projecting OCI revenue to skyrocket and are building gigawatt-scale data centers. However, the Gen AI divide shows that while Oracle might be crushing it with the AI hyperscalers, the broader enterprise market, the very customers who would be adopting their enterprise AI solutions and expanding OCI usage, are really struggling. This widespread lack of ROI could make those sales cycles longer, increase skepticism, and potentially slow down Oracle's broader enterprise AI adoption beyond their core AI-native clients. Let's get to the numbers. How do we quantify this potential impact on Oracle's bottom line? First, the news directly affects Oracle's biggest segment, the cloud and license business, which makes up over 85% of their total revenue. Based on the report's findings, we're estimating a 2.0% reduction in Oracle's overall total revenue growth rate for the upcoming quarter, Q2 fiscal year 2026, compared to what was previously expected. Now, here's the crucial part, operating leverage. Oracle, with its capital-intensive cloud infrastructure build-out, has substantial operating leverage, which we estimate at a multiplier of 2.0. This means for every 1% change in revenue, Oracle's operating income changes by a magnified 2.0%. So, that 2.0% revenue growth reduction multiplied by 2.0 gets us to a 4.0% hit to operating earnings. Oracle's non-GAAP EPS guidance for Q2 FY 2026 is between $161 and $165. Taking the midpoint of 163, a 4.0% earnings hit translates to about a 0.0652 impact on EPS. We've modeled 3 scenarios for this Q2 EPS impact. A low-impact scenario sees a negligible hit of about negative 0.163. Our moderate and most likely scenario, which we assign a 60% probability, is the one we just walked through, a negative 0.0652 impact. And in a high-impact scenario, if enterprises truly pull back on AI spending, we could see an impact of up to negative 0.1304 per share. So, how has the market reacted since this report dropped around August 19, 2025? Perhaps the market believes Oracle's deep ties with leading AI innovators will shield them from this broader enterprise struggle. All right, time for the verdict. Is this good, bad, or neutral news for Oracle? Based on this analysis, the GenAI Divide report is unequivocally bad news for Oracle's immediate future. While their contracts with AI leaders are strong, the widespread struggle of 95% of enterprises to get ROI from GenAI creates a substantial headwind for Oracle's broader enterprise AI adoption strategy. This challenges the narrative of easy, widespread GenAI transformation and could temper investor enthusiasm for Oracle's aggressive growth projections beyond its core hyperscaler clients. So, what's my take on Oracle after all this? I'm putting a hold on ORCL for now. On one hand, their direct partnerships with major AI companies like NVIDIA and OpenAI are incredibly strong, pointing to long-term potential. But on the other, the GenAI Divide introduces significant short-term uncertainty for their broader enterprise growth. Until we see clearer signs of how Oracle plans to bridge this ROI gap for the vast majority of businesses, I'd advise caution. That's all the shock for today, folks. If you found this insightful, hit that like button, subscribe to Ticker Shock, and let me know your thoughts on Oracle in the comments below. Remember, this isn't financial advice, just educational content to help you navigate the markets. Do your own due diligence. See you next time.